All right, thank you, everyone. If I could ask everyone to please go ahead and return to your seats so we can finish up with our last panel. Looking forward to a positive discussion. Wonderful, thank you very much. I would like to take this opportunity to welcome a very special guest to the stage who's going to offer opening remarks to get our panel started today. We're very honored to have with us the Assistant Secretary for International Trade and Development at the U.S. Department of Treasury, Alexia LaTortue. And she has spent many years at Treasury and many years in government, has a distinguished background in U.S. government. So Alexia, we're very delighted to have you, and if I could please welcome the Assistant Secretary to the stage.
So thank you, Emily, so much for this warm introduction. It's really an honor to be speaking here today to the distinguished members of the Bretton Woods Committee. And I'm really pleased to be here in Marrakesh. I'd like to express my support and sympathies to the people of Morocco who have lost loved ones, livelihoods, and homes due to the devastating earthquake. I think it speaks a lot to their resilience that they're able to welcome us so warmly for this annual meeting. The genesis and the mission of the Bretton Woods Committee speaks to me deeply personally. I'm a committed multilateralist as the daughter of Haitian parents who grew up in West Africa and Austria and then came to the United States for college. The committee's mission and vision also speak to me as a professional. I'm proud that former Treasury officials instigated the idea, and I try to espouse the values of the committee every day in the work that I do. And so thank you, Bretton Woods Committee, for your valuable contributions to the multifaceted subject of multilateral reform. As we at the Treasury Department have worked very hard over the past year to reform the multilateral development banks, we have often thought back to that pivotal conference in July of 1944 that launched the institutions that we're discussing here today. How big the challenge must have felt, how great the responsibility, but also how enormous and exhilarating the opportunity. And there are lots of similarities for us today. The challenges we face may be different, but they're no less complex. And now, just as then, none of us acting alone can be effective. Exactly 1 year ago, just before last year's annual meeting, Secretary Yellen launched a bold initiative to evolve the multilateral development banks to better tackle global challenges. Today's big challenges, climate change, pandemics, fragility and conflict, do not respect borders and impact all of our regions and the globe. These challenges are increasing in frequency and severity, disproportionately impacting the poorest and most vulnerable people and countries, and rolling back hard-won development gains. There simply will be no sustained progress on poverty reduction and achieving the Sustainable Development Goals unless countries are better equipped to prepare for, mitigate, manage, and recover from these global challenges. And for this, the multilateral development banks are vital partners, but they themselves need to be retooled to support countries to meet 21st century challenges. You know this, but what's at stake is terrifying. Climate change is worsening heat waves, droughts, floods, and storms that increase poverty and impose major economic costs on economies, affecting so many sectors, including agriculture, and especially so in the countries that are the very least able to cope with them. As we approach the 4th anniversary of the beginning of COVID-19, it continues to be evident that threats to global health can disrupt entire societies and economies and cost human lives. This pandemic drove the first increase in global extreme poverty in a generation. There were 70 million more people living in poverty in 2020 than in 2019. We lost 4 percentage points of GDP, and we have yet to fully account for the impacts of learning losses. And what I will say next is particularly poignant this week. Over the last decade, violent conflict has spiked, causing immense human suffering and contributing to extreme poverty and significant displacement of people, while also impeding economic growth and absorbing a large percentage of national budgets. Russia's unjust and brutal war against Ukraine is, unfortunately, but one example. So clearly, these problems are not contained within national borders, nor can they be solved by any one country acting alone. These are fundamentally global problems that hamper the ability of countries to grow, generate jobs, and reduce extreme poverty. Now, the United States has long viewed the multilateral development banks as central to the development finance landscape and as vital to addressing countries' most complex development priorities. This remains true today. But, as I mentioned, the MDBs were not designed to address the kind of challenges we currently face. And that's why we've worked so very hard with a strong and growing coalition to press for reforms at the MDBs across 4 pillars. First, vision and mission, to integrate global challenges into work to achieve MDB's core goals. Number 2, incentives, aligning country, institutional, and staff incentives to this new vision and mission. 3, operational approaches, building this integrated approach into the organization and the operational DNA. And 4th, and importantly, financing capacity, stretching balance sheets and pursuing innovative measures to create additional space for additional lending. Secretary Yellen's call has benefited from the work of many. I see Siddharth here in the front who will be on the panel. Many of the ideas have built on the work of the G20 Eminent Persons Group report on global financial governance. Franny was meant to be with us of the G20 Capital Adequacy Report. Having Standard Chartered represented here today is also important. And of course, this week, the G20 will receive the 2nd volume of the G20 Independent Experts Group that will be discussed with finance ministers. And so it's really gratifying to see a range of shareholders, think tanks, civil society, philanthropists, and of course the management, I'm looking up front here at Swazi, and of course the management and the staff of the MDBs themselves echo the urgent need for MDB evolution. Together, I believe that we have achieved substantive progress. At these annual meetings, governors will endorse a robust package of World Bank evolution reforms that build and go well beyond those endorsed at the spring meetings earlier this year. Among the most important of these reforms are, first, an updated World Bank mission and vision that explicitly acknowledges that addressing global challenges is key to achieving the World Bank's twin goals of ending extreme poverty and boosting shared prosperity. In short, it is creating a world free of poverty on a livable planet. Now, this does not mean that the World Bank is moving away from traditional country-driven work, but it does reflect what I heard loud and clear at the African Climate Summit in Nairobi. Climate and development, as President Ruto says, are positively reinforcing goals. Second, through refocused diagnostic, country strategies, and results measurement, we are strengthening the World Bank's operational model. The World Bank's programming must account for the fact that a country's development needs stem from regional and global challenges, not just country-specific factors. Third, by adopting concessionality principles, we are guiding when and how targeted concessional resources of the World Bank should be deployed. We will soon adopt a mechanism for allocating those resources to activities with the highest impact on global challenges. Fourth, the steps we took at spring meetings will increase World Bank financial capacity by $50 billion over 10 years. And we are now going further by establishing a portfolio guarantee mechanism and enabling shareholder hybrid capital purchases. And this is just part of the at least $200 billion in additional MDB financial capacity that will result from the G20 MDB capital adequacy framework recommendations already adopted or under consideration. You may have heard that just last week, the Asian Development Bank Board adopted measures to unlock $100 billion in extra lending headroom. To demonstrate the United States' commitment to this reform agenda, President Biden has requested funding from our Congress that would enable the World Bank to boost its concessional financing capacity. This includes a guarantee to the new guarantee the portfolio guarantee platform that would enable $25 billion in additional IBRD, and a large grant to the Global Public Good Trust to offer this new capacity on better terms to incentivize countries to tackle global challenges. And it also very importantly includes $1 billion for IDA's enhanced crisis response window to support the poorest countries which continue to face significant economic headwinds. We're pleased that the G20 leaders voiced support for this effort in September, and we encourage other countries to also join us. This all said, we are by no means done, and there is a lot of work left. The World Bank will need to robustly implement the evolution reforms already adopted. The World Bank will also need to complete reforms underway, particularly finishing the concessionality framework, adopting staff incentives on work on global challenges, embedding vulnerability in the bank's resource allocation, and increasing speed and agility, all of which will further embed addressing global challenges into bank operations. And we will need to launch the work on evolution reforms that have not yet been taken up. For example, and very importantly, again looking at Standard Charter here, increasing private capital mobilization by setting ambitious targets and reporting against them, adopting staff incentives to mobilize more private capital, creating a culture of responsible risk-taking, and looking at how IFC and MIGA can better utilize and scale instruments like guarantees, political risk insurance, and foreign exchange solutions. Also on the agenda ahead is following through on the Capital Adequacy Framework report recommendation to incorporate a prudent share of callable capital into the capital adequacy frameworks of the development banks. We have started work on this with both the MDBs and major shareholders. Looking ahead, we're now expanding this evolution agenda to the regional development banks and encouraging all the development banks to work together better as a system. We will also spend more time exploring the fragility driver of evolution. We've done a lot on climate so far. Now, I'm fully aware that this is not the first time that there are efforts to reform the multilateral development banks. So let me end with 3 quick thoughts of what this time may just make the difference. 1, our North Star has always been impact. And MDB evolution in many ways is about change management. Change management is hard. Ultimately, to achieve the impact we must see at speed and scale, we need fundamental culture change. That's not easy, but we've integrated it as a core part of MDB evolution and acknowledged its importance. We also have a proven leader at the helm of the World Bank in Ajay Banga, who has both the interest and the proven track record to focus on these issues. Second, we have unparalleled political will now to transform MDBs. Evolution is at the center of the G20 agenda. Shareholders across borrowing and non-borrowing countries, middle-income countries and low-income countries are engaging and seeking to align around priority reforms, and they are demanding change. And she can't say it, but I can. We also have Secretary Yellen fully engaged on this agenda. 3, we must all adopt an approach I call stick-with-itness. Stick-with-itness requires sprinting to deliver on low-hanging fruits and results for countries quickly. That builds trust, and it shows that the Evolution Initiative can and does deliver. But it also requires the endurance of a marathon runner for the more difficult and complex reforms. This shows that we mean business, and we are in it for the long term. It also means resisting changing course or priorities too quickly. We need to follow through on ideas that generate consensus and keep moving. I'm proud the Treasury Department and the Biden administration have a firm long-term commitment to MDB evolution so that we can deliver a better banks for countries. And it has been quite an exercise of collective action to help shape this agenda and to begin executing on it. The excellent panel that will come up right after me is certainly part of this collective action, as is the work of the Bretton Woods Committee. Thank you so much.
You will from there? Yep. Thank you. Should we sit down?
Mm-hmm. Okay, thank you very much to the Assistant Secretary for those wonderful remarks and giving us an overview of where the World Bank evolution and MDB evolution roadmap stands, some of the encouraging positive momentum and commitments that have been brought to these meetings here in Marrakesh. And I think they set the stage for us to build on those a bit more. And we've really heard in all of our sessions today, several, a lot of, I think, summary of the challenges that we face, the immense challenges, global challenges, new challenges. We talked on the first panel about this massive financing gap. This incredible demand for moving capital and allocating capital efficiently, and the best ways to do that. We heard from the managing director at the IMF a bit about the economic outlook and how she views some of the IMF's role in meeting these challenges. And then, of course, we got to hear from the Treasury on some of the priorities for the MDBs. So what we're going to do with our panel here today is try to bring all of this together, and we're going to try to focus a bit on some of the solutions rather than just addressing some of the challenges. So let me introduce my fellow panelists. I'm very grateful to have such an esteemed panel of guests with us. I have to my left Mr. Jose Viñals, who is, of course, Group Chairman of Standard Chartered. He's also on BWC's Board of Directors, and I very much appreciate Jose's involvement and very active involvement in BWC. So thank you very much for joining us today, Jose. To his left, we have Mr. Zhang Zhenzhang, who is the Executive Director for China at the IMF. Thank you very much for joining us today. We know this must be a very busy week for you, so we appreciate you making time for us. To his left, already been introduced today, we've heard from Axel Weber, who is, of course, the former Group Chairman of UBS. And he is co-leading the Bretton Woods Committee's work on our multilateral reform effort with Joachim Levy, who couldn't be here with us today. And they are working with Siddharth Tiwari, who we have here on our end, who's the Vice President of the IFF and a long and distinguished career at the IMF. And Axel and Siddharth have, as I said, been working with Joachim on really developing some ideas and some innovative solutions to some of these problems that we've discussed. But maybe for anybody who wasn't here for previous panels, Axel and Siddharth, maybe I'll turn it to you first to maybe give a bit of a summary about some of the challenges and the gaps in the system that we're facing, and then a bit of an overview of the Bretton Woods Committee's work and the work that you all are doing. So Axel, maybe over to you to start.
Yeah, and since, thank you very much, and also thank you for being on the panel. Since you heard me already on the previous panel, I'll try and be short and let Siddharth sort of go into most of the stuff. Just a way of setting it up, which sort of just repeating for those that weren't in the room, we faced a multitude of crises since the last major report of the Eminent Person Group on the reform of the IMF was out. And many of those recommendations were taken up or being implemented. But if you look at what happened since, so therefore it's not in the report because it happened afterwards, we've seen a massive shift in geopolitical challenges, whether it's the unjustified war in Ukraine, whether it is the recent breaking out of war in the Middle East. We have a multitude of geopolitical challenges, and we have basically stretched relationships, whether it's the US and China and others. At the moment, we're facing, I would say, a development that for international globalization, that needs to be reestablished because it's not the obvious way going forward. Second, we've had the pandemic, the climate crisis, we're facing a cost of living crisis, we're facing a rise in inequality, and there is re-emergence of new financial stability risks, so a multitude of problems. Where we need to go is strengthen the existing architecture, and that was our starting point, not reinvent the wheel. Let's look at what happened since, and let's see how we can augment the mandate and the governance on those various institutions that already define the international architecture. So whether it's the IMF and the World Bank, the Millennium Development Banks, whether it's the United Nations organizations, whether it's the COP process, all of that needs to be brought together to a coherent framework of collaborating to the benefit of fighting climate. Now, the challenge is that public finances is stretched. They've been brought to the limit by fighting the recent crisis that we've seen. There's a lot of private capital out there, but private capital in its core use will only address issues that in itself offer a financial return, and I talked about that. And we face externalities, and usually externalities are not solved by private sector processes because it's very hard to use a price mechanism for internalizing them. So we need policy to help on the internalization. And so the report we're trying to write really talks about new forms of private-public partnership for the benefit of climate and the role everyone can play in it. But we felt if you want to create a new system top-down by a great new design, this will not happen. So we need to evolve the current system. I'm using the same words as the Undersecretary, using the same words. We need to evolve the current system to take on board additional mandates. And the key point I tried to make on the panel before, new tasks, new money. This will not come for free. This will come with a lot of additional commitments. And there I also say it, the core mandate of the IMF and the World Bank, there's still a lot of work to do in their core mandate. We're not done on development, we're not done on financial stability, so climate is an extra task that both need to work. Additional, and the amount of money you need is pretty high, I mentioned some numbers, but we felt at that point, everyone's with you, and then when you start talking about how to organize things, people are veering off. And we felt there's a lot of benefit in being very concrete about 4 work streams that you need to address in order to make the climate fight work. And the first one, it's all the work on basically extending the supply of new clean energy. Very often we don't talk about it here because these are national energy backbones, these are national programs, and there are a lot of the research and development in the corporate sector that goes into it. And the US program, for example, on the Inflation Reduction Act is a lot about creating investment opportunities and incentives for that move to better forms of cleaner energy. And it will happen. The next one we need to do, and that's a bit more tricky, is decommission coal-fired plants, and they're largely in developing countries. So this will not work without 2 things. The first one is basically technology transfer from the industrial countries to these countries, and second, financial transfers to make it happen. That's where you start having already some dissent. And I very much worry that if we are going beyond that, and we need to go beyond that, the common denominator is even smaller. Adaptation action to counter global warming, starting from, whether actually the diagnosis that there is global warming and it should be countered is not shared by everyone unilaterally. The action recommended to doing that will very much depend on whether you are in a part of this planet where you're less affected or whether you're a climate fragile country, sort of a frontier country in the climate fight, and you need a lot of money from the outside. It needs to be directed there, and it needs to come from the developed world. And the last one, which is pretty obvious, is the global commons. Fighting for the global commons just because they happen to be placed in a number of countries that cannot afford the financial resources to move away from deforestation, find different livelihoods for the people, and also get global money to preserve these, including reforestation, including clean oceans, etc., is another part. So all of these 4 work streams, we need the IMF, the World Bank, and the global institutions as a core anchor for that system, as the guardian to make sure that the national action done bottom up adds to something that is meaningful top down. And this role as a global guardian of these global commons, in my view, is a supplement to the IMF task on fighting financial crisis and that of the World Bank in creating a better world through resilience and through development. And for that, what we need is a lot of money. We also need a different governance. But what is more important than the governance, and I said that and I'll end here, is we first need the money. I'd rather take the money and not change the governance and get things done than not having the money and changing the governance and hope for the money to come along. So Siddharth, who is sort of working with us on this project and has a lot of ideas on how to get this done, I'd like him to portray a bit, sort of just a flash, where we think some of the common action is needed, because I do think it's this broad agenda we need to work on, and we really want to come out with some recommendations for the COP process, and so there's very little time to write this all up, but we also want your feedback, so please do feedback in this round.
Okay, so just to pick up from where Axel left, on the first part, to be really concrete about things and sort of come down to actionable things. On the first part, on expanding the supply of clean energy, MDBs can do some work, but this is largely the development of new technology. They don't have a role, they don't have the money to be the leaders in this field. What they can do is de-risking to some extent, but however much they may de-risk, it's not going to be enough. That you need to improve the local capacities in countries' capital markets, deepen them, standards and codes. And this is very traditional work of MDBs. They need to double down on it and get moving. There are 2 areas where I think the group is cautious. One, there are suggestions about MDBs guaranteeing exchange rates, foreign exchange levels. I don't think anyone on the group wants to move back to managed exchange rates. That era is gone, and doing that will divert precious money and it will be wasted. The second is, I think it's easy to say, reduce the risk weights for the Basel Committee. The countries of the South are precisely the countries when this transition takes place, their banking system will be hit because the real balance sheet and the financial balance sheet is likely to weaken, and any preemptive move on regulation will be costly. And it'll be costly by multiple times the reduction in the weights. So we need to be careful on that. The second area that Axel talked about, phasing out coal, I come from India. It's an existential challenge for phasing out coal. These are people at the bottom 20% of the population. They lost 1/4 of their income in pandemic. I was looking at some cost of living data, 37% increase in prices. Add 25 to that, do your arithmetic. They are on the verge of livelihood. And if you take coal away, that transition needs to be financed. So there's a trade-off here, right? I mean, if you look at Asia, excluding China, it's 1.5 GT of CO2 a year. That's huge, but at the same time, that transition needs to be financed by resources outside. Where the MDBs can help is in adaptation. That's where they have the firepower. This involves construction projects of a long maturity of financing that's needed, that they're quite, they're adept at providing this kind of financing. And the last, which we're beginning to look at, is protecting and expanding the forest. It's something that we've not looked at that much before, but this is the area where there is room for action. Lastly, as Axel said, they will need to take on the additional responsibility of technology transfer. It's not going to happen on its own, and they need to be a conduit for that. So with this as background, I think the group looked at what are the gaps in the system that need to be filled. And I'll be very concrete. There are 6 to 7 gaps, and there's 6 to 7 solutions to do it. First, for 300 years, you and I have known through our ancestors that there are greenhouse gas emissions. For 100 years, after Pigu's article, we know how to deal with it. But the crisis moves on because the carbon footprint of corporates is unknown. And if you think about it, in whether it's 3 trillion a year or 5 trillion a year, a bulk of that has to come from establishing the right carbon price for the corporates. So that's the first area where there's a gap. There's a private sector gap. Second, and Axel can come to it later, there's an absence of adequate instruments for private sector investment, and Jose has led this quite a bit himself. Third, there is no mechanism, no enforcing mechanism to prevent greenwashing. But there are ways to do it, and there are very simple ways to do it without reinventing the wheel. So that's the private sector gap. On the public sector, it's interesting that 3 gaps. One, there is no institution that has the overall responsibility for coordinating financing. And I use the word coordinating deliberately for climate mitigation, adaptation, and transition. There is no institution that has that responsibility. Take it a step further. There's no institution that has the overall responsibility for implementation according to standards that are consistent across the 5 continents to ensure that money doesn't move to the lowest common denominator, and to ensure that the private sector has the confidence that the standards are being met and they will be enforced if they go into it. And last, and I've been part of this, every year there is an eminent persons group that looks at these things. I spent 2 years of my life looking at it. I think the time has come that there needs to be a permanent mechanism within the multilateral system that looks at this, both whether the targets are ambitious, but more importantly, at the end of the year, to assess what progress has been made. So over a period of time, data is publicly available to the public to assess whether progress has been made or not. It should not be up to every group that is constituted year by year to do this. And without major changes, the 6 areas that I identified, without changing the articles or the other areas, all 6 of them can be addressed in a finite time period. I'm going to stop here.
Okay, thank you, Axel and Siddharth. A lot that you are looking at, certainly. So why don't we zoom out just a little bit before we kind of get back into the details. And I want to go to Zhang Zhenzhang first. And we've talked a lot today about we need more financing. We need all the financing we can get. We need official sector, we need private sector. The system needs to be able to deliver the financing at the scale that is required. So how do we do that? How does the system deliver the financing required, and what is the role of the IMF in doing so? Yes.
Okay. Thank you very much. I'm very glad to join this panel. I found the panelists are all used to work in the fund, and staff all in the board of governors. So I'm very glad to attend. Before I start, I think as required by the code of conduct of the IMF, I need to make very clear the following disclaimer. That is what I said today here, only my personal view, not represent any of the fund, the board, and any board members. Of course, also not the opinion from the People's Bank of China, only myself. This is, I need to be made clear. Next year, we will celebrate the 80th anniversary of this current international financial architecture. It's interesting to recall that this architecture was designed and established during the Second World War. So it's thanks to the founding fathers' strategic vision and long-term thinking. This architecture worked and contributed to the post-war peace, development, and stability. So today, we face also the different small kind of wars, geopolitical tensions, but I think if all members work together, we can strengthen the current international architecture. So as the previous speakers say, we face financing gap. That's true. So how to fill this gap? I think we need to think about the traditional way, how we fill the gap. As you said, we have the MDBs, official sectors, and the private sectors. So I will go through the different channels so that how we work together to fill the new challenges, new gaps. So first on the MDBs, I think the MDB, initially we only have World Bank. Then gradually we have different regional banks, MDBs. And in recent years, we have the new development bank of the BRICS, and also we have the AIIB, Asian Infrastructure Investment Banks. So all the MDBs can work together. For the World Bank, I think the most urgent thing is that we need to increase its capital. And at the same time, modernize its governance structure. So that is the one coin, two sides. Yeah. I just want to give you an illustrative number. I know that World Bank currently think about through balance sheet measures to increase in the coming 10 years lending capacity of $50 billion. But I think it's too small to the challenge. So one illustrative number is that if we can increase the IBRD, $100 billion capital. That requires about $7 billion paid in capital. So the cost is small, $7 billion paid in capital. But it will translate into $400 billion lending capacity. So that's a huge difference with the use of balance sheet measures. So that is for IBRD, it's alone. So and the other regional MDBs could also increase its capital because all the members have the need to increase the capital. So that's the first part. Second, for official sector, I don't think its need in the realities need a new commitment or new proposal. What we need urgently is to implement our already committed things. There are the two most famous commitments by advanced countries. One is the 0.7% of GNI ODA target each year. The second is the climate financing commitment of $100 billion per year by 2020. So already many years passed for both these two. So I think urgently the official sector need to implement these two commitments. Action is more important than words. Certainly, there's a pressing need to recalibrate banking recognition to align with the evolving financing need, the financing landscape. Because Basel III, they have the goodness to strengthen the financial sector, but the capital requirement give the incentive for internationally active banks to lend to low-income countries and emerging market because the lending to these countries, the capital requirement is higher. So I think we need to be more friendly for the regulatory rules to incentive banks to lend to these countries because they are the bigger part of the financing to fill the financing gap. Fourthly, I think we need to the current system should encourage and facilitate project financing rather than simply budget financing for the current expenditures. Because project financing, you have the assets behind the debt. You have the productive assets. That's it. And also, these assets can generate cash flow, so that the debt is quite risk is lower. We found that in the recent years, because of the euro policy rate is negative or zero, so some African countries they issue a lot of euro bonds, but this bond is using for current expenditure. But then when things get worse, they cannot pay. So that's the problem. So we think the project financing is better for this low-income country compared with bond financing. Even for green bond is backed by assets, green projects. So it's better than the purely the government bonds. So that's the four channels I think we can work together to face the financing gap. Then what is the role for the IMF? I think the IMF played a very big role. The first thing, they need is to also the IMF's quota increase and the governance reform, so that make the members trust the IMF, because they want the IMF to be a trusted advisor. The IMF needs to give the capacity development for these low-income countries to improve their public management, finance management, to better have a tax revenue, better expenditure allocation, all these things. That's the one important thing. The second thing is that the establishment and the operationalization of the fund's resilient and sustainable trust. That is a significant milestone in providing financial support in the area of climate change and disaster prevention areas. So that's the IMF they are doing. China is proud of to be the biggest contributor of the funding to the RST. So in the future, I think the IMF should manage to call more contributions to this trust fund, and also to make the financing by the IMF play a catalytic role to appeal private financing into these countries in the areas of climate change. That's the second area. The third area is that the IMF debt-related policies should be adaptive to take a more balanced and comprehensive perspective on project financing, so that work together with the regulatory system to promote project financing. I think I just stop here. Thank you.
Thank you very much. I'm going to turn to Jose now. We talked a little bit, Mr. Zhang talked a little bit about the official sector financing and the role of the MDBs and IMFs. We've talked a lot today about the need for more private sector finance. How do we crowd that in, and how do we mobilize that? So you're heavily involved in this, Jose. You're on the UN body, the investors board that looks at this. Standard Chartered is part of the private sector lab that was just announced by Ajay at the World Bank. So what is being done on the public and private partnership side of things, and what more can be done going forward?
Well, thank you very much, Emily. And I think that a lot of interesting ideas have been put forward by my fellow panelists, so I can be relatively succinct. And let me tell you that in terms of the public-private sector collaboration, and I think this is critical, because this collaboration, this partnership, is the only way that the world can cope with what I believe is the largest global capital reallocation that the world needs since the Industrial Revolution. Reallocation of capital across countries, across regions, and across sectors. So we're talking about something which is really massive. And people have tried to put numbers on it. It's 2 trillion, 3 trillion per year. We could discuss the numbers. So it's not a 1 trillion question. It's a 2, 3, or more $1 trillion question every single year. And I can tell you one thing. I think that all the initiatives that have been talked about scaling up the capital of the multilateral development banks, I think is a necessary condition, but that is not going to do it alone. It would only be the lever that allows for private capital mobilization to complement this official funding and then really move the needle. In the last couple of weeks, the IMF has published in one of its flagships, the Global Financial Stability Report, one very interesting chapter, which has one piece of data which I believe is very interesting. If you look at the amount of financing which is required just for climate, okay, for net zero, the private sector is providing now 40% of the needs of the investment. It should be providing between 80 and 90%. And the answer is, how come the money is not flowing? because there is a wall of money. If you look at the assets under management of financial institutions in the world, asset managed, et cetera, we're talking about hundreds of trillions of dollars. But that money is not flowing. And the money is not flowing, except in a small amount, because the perception of risk is too high. And while it's true that it normally takes two to tango, here I think it takes three to tango in order to unleash this wall of private money, in order to be able to move the needle regarding financing for climate and other sustainable development goals. And I think it takes important actions on the part of national governments, which need to put the policy environment in place, which enables, not deters, private investment. That's extremely important. Local governance, rule of law, etc. Second, you need the private sector to work, financial institutions and non-financial institutions, to work with governments, and that is happening, in order to develop, let's say, sustainable projects. And then you need to make these sustainable projects bankable, which means having a risk-adjusted rate of return, which make them attractive for private sector investment. And that's where the multilaterals come in. And now this is happening. We are involved, Standard Chartered, in many, many projects around the world, in emerging markets, in developing economies, where you use this model for project finance. It's called blended finance. And it's the key for mobilizing private capital. But this is happening at the retail space. And what you need is to scale it up systematically into a wholesale space. And I think that's what the evolutionary approach that Alicia was talking about becomes very important. Now you have initiatives happening where this blended finance is being scaled up for particular countries, the so-called just energy transition platforms. Let me tell you the case of Indonesia and Vietnam. $10 billion have been committed by banks in order to finance, in a blended finance manner, those particular investments for climate, actually for decommissioning coal-fired power plants. You have the G-Funds initiative. You have the United Nations Alliance of Global Investors for Sustainable Development, which is the body that I chair. And then you have other bodies like the World Bank Lab, which are trying to enhance this partnership. So there are initiatives in place, but we need the three big things there: that national governments up their game, that in project sort of selection and preparation, that they receive a lot of capacity development from the multilateral development banks, that the multilateral development banks really change the way they work. In the lines that Alicia was saying, I would say going beyond that. And thirdly, that imaginative solutions are put in place so that projects can be de-risked in a big scale and the private sector can invest. I'll give you an example. At the United Nations Alliance, we're working with one very large, globally renowned asset manager to develop an SPV, which is called the Sustainable Infrastructure Investment Platform, to be able to have quite a number of multilaterals co-investing together with many institutional investors across an array of projects, so that you have something which is a model that can provide the necessary investment in a way that scales up. And that vehicle, which has been designed, will run much faster if you have the multilateral development banks reform, which will scale up the use of guarantees so that the private sector can move at faster speed. So lots of things are happening, but you need much more to come.
Thank you, Jose. Building on that a little bit, I want to go back to Mr. Zhang and ask him. So, I mean, it's clear that to incentivize private sector investment, we're going to need sort of a standardized taxonomy and, some green standards, right? There needs to be some global standards here. The EU and China have done a lot on this front. So kind of how far are we from reaching consensus on this, and what are some of the roadblocks?
I I'm always optimistic because if you see the progress, it's really promising. It's not only in the bilateral PBOC and the EU, but also in the G20 and in other platforms. So I can briefly share some of progress so you can see it's really hopeful we can have these public goods. Of course, in the EU and PBOC, that we already have the common ground taxonomy. That's reached 2020. Then in 2022, we further upgraded this so-called CGT. It can include more than 17 activities. For the bilateral, not only China, EU, but also other, China has, in other countries, like in the UK, also has this similar kind of cooperation. In the multilateral level, in the G20, PBOC co-chairs the G20 Sustainable Finance Working Group with the US Treasury. So this group is already achieved sustainable development goals for the enabling finance for this SDGs. So this already, the result of this working group already endorsed by the G20 leaders last month. So that is a very high-level agreement. Then in addition to the G20, there is a network of central banks and supervisors for greening the financial system. This platform includes more than 127 members and coming from 100 countries. So the work involves a lot of different parts of the world. So that's why I say it's very optimistic. Going forward, I think the key thing is that politically, every country should stick to the target for green growth. Secondly, is we need to, for this taxonomies and standards, be inclusive, to be adaptive to different countries' situation. You cannot one size fits all. You must be inclusive and adaptive. Yeah. I just stop here. Thank you.
Well, I'm happy to hear some optimism today. Maybe I'll turn it to Siddharth and Axel to respond to a little bit of what we've heard here and share some of your ideas on how we sort of enable this standard taxonomy, address the gap of greenwashing that we've discussed, mobilize some of the private sector investment.
So maybe just a step to build on what was just said. One way to complement what Jose said was that the carbon footprint of corporates is not known, and it's commonly known that 1% of publicly listed companies are responsible for 40% of greenhouse gas emissions. So just look at the numbers. 1% of publicly listed companies, 40% of greenhouse gas emissions. And that makes disclosure requirements that much important. The International Sustainability Standard Board has come out with the 2 disclosure requirements, S1 on sustainability, S2 on climate. They need to be made mandatory on the 5 stock exchanges, Tokyo, Frankfurt, Hong Kong, London, New York. And we know what will happen when they're made mandatory. There will be a data dump, that most corporates will dump data. And what you need is a complementary public digital infrastructure that takes that data and moves it into machine-readable data. And it is at that point that rating companies, activists will be able, or institutions with assets under management will have the data to be more active, but more importantly, it will allow corporate boards to make plans over time to make this transition part of their business model rather than to face abrupt regulatory changes towards the end. So that's something the group is looking at in seeing how to make this effective. And the second step will be that in Asia, these emissions are coming from state-owned enterprises. They're not coming from corporates. And so the state-owned enterprises, the larger ones, need to be brought into the net, into the umbrella, under similar standards. And if you do the math, what I'm describing is in multiple trillions. It is not a small number that is involved. And so here the path is forward is a few years. A lot of work needs to be done, but it needs to be bridged. I'll give Axel the space now to look at the official sector, some of the suggestions we had.
No, I think Jose had said absolutely rightly, the private sector, bringing the private sector in here is key. And I think there are ways for doing that. One of the workflows, I happen to be based in Frankfurt, the ISSB is in Frankfurt. They're really hit the ground running. There's now 2 standards. We're seeing that being put into corporate disclosures. Companies like UBS that I chaired for 10 years all have their voluntary commitments. They have their sort of net zero passes mapped out. The board subscribe to that. We disclose that. We disclose our trajectory. We disclose double materiality, basically what we do to change our carbon footprint and how that affects our business model and how the change in the environment affects the business model of the bank. All of the corporates are on the move. What you need is you need some umbrella organization above that basically does the global questions. In addition to all of these standards, none of these standards, when the FSSP has started, it was clear that there would not be a single disclosure standard at the moment. We don't have a single disclosure standard for financials. We have ISSB and US GAAP. There was no complete convergence of these financial disclosure standards. And what we're not seeing evolve is a global disclosure standard here. There are different rules, say within the SEC, more looking at investor protection, and European authorities and the European legislation looking more at consumer protection. Again, there's a lot of work you need to bring all of these workflows together for consistent climate disclosure and consistent climate information so investors and clients can act on it. But top down, we also need a pathway for the global economy, and we need the key organizations like the IMF and the World Bank to play a coordinating role with the public sector, with the private sector, with the more developed world and with the emerging market economy so that everyone is on a joint trajectory. Somebody needs to do the math whether all of that adds up. It's part of the Paris process. We've seen in with President Macron's meeting that was mentioned in the previous panel, there is some actioning happening there. People are trying to make sense. Does it all happen? Is it enough? And first order approximation, everyone's hears, it doesn't all yet add up and it's not yet enough. And so we need to do what Jose said. We need to scale it up. He used the word take it from retail to wholesale, which means basically we need to have the banks make this as part of their investment and financing strategy for the corporate sector rather than being collectors of capital from retail investors. And that only will deliver scale. I was on a panel recently where somebody said you just got to make it a business model globally to put that money at work for climate rather than putting it at work for other topics. And I think that's really where we need to work a lot more.
So we have a few minutes left, and I want to get to the governance question a little bit before we get to audience questions. So I'm going to ask one question that maybe each of the panelists can respond to. I mean, we've heard today we don't need new institutions in terms of coordinating global public goods, coordinating financing. We need to lean on the existing institutions that we have, but they need to be reformed and they need to be fit for purpose. So the question to all of you to respond to is, how do we do that? What needs to be done? What's the roadmap from here for reform? And Jose, maybe I'll just start with you and go down the panel.
Yeah, and as you go down the panel, you'll have more and more concrete solutions.
Yeah. Because
Axel and Sidar have been working precisely on this. And I think it's right to say that the world doesn't need another institution. If we were to design the international financial architecture ex novo, we might think of it. But now, we are where we are, and we need to be realistic and pragmatic, and also we don't have the luxury of waiting, because the challenges that we have talked in terms of global challenges of poverty, pandemics, climate, all of those need to be urgently addressed and with the scale that the world needs. So we cannot wait. So what we need to be is pragmatic. I think that's in the spirit of what has been in the conversation, which is to look, and I would start with the IMF and the World Bank, and say, okay, here you have the two quintessential Bretton Woods institutions, which have clearly had a division of labor throughout their history, with the boundaries sometimes shifting a little bit, but still there is a reasonable division of labor. And we think of climate, for instance, then the World Bank looks at it from the developmental side, because as was mentioned before, climate and development are closely interlinked. But if you look at the IMF, why is climate on the agenda? Because the IMF looks at macro criticality. And clearly climate is something which is critical for the mission of the fund, which is all the things to sort of maintain, to safeguard macro financial stability, and so on and so forth. So the question is, what do you need to do inside of those institutions? And now we have a very significant discussion going on the reforms of multilateral development banks in terms of focusing on impact, don't have an accounting view, but an impact view on what it is that they have to deliver, focus on the outcomes rather than on the financial sort of rubrics of the balance sheet, total impact. And you have the scaling up of many innovative solutions in the multilateral development banks which are going to serve the world. But is there anything beyond that needed? Does the IMF need to strengthen its governance as well? Does the World Bank needs to change both in terms of its operational work, which it does, but also in terms of the division of labor it has with the IMF? And I think that Sidar was mentioning before that there could be one coordinating solution and one implementing solution if we think of climate. How should the IMF and the World Bank divide up the roles? I think that's something I leave for my fellow colleagues. But yes, I think we should be realistic, pragmatic, and then also be time sensitive, because the world cannot wait to solve these challenges.
I think that's very well put, Jose. And Mr. Zhang, maybe you could speak a bit to the governance reforms, pick up on what Jose mentioned in terms of the IMF.
Yeah. First of all, I just want to echo Jose said, IMF, World Bank could be coordinated and collaborated extensively. Like in the IMF has the RST, focus on climate change. And World Bank, of course, also they have their portfolio focused on it. So these two institutions need to collaborate together. So that's the first thing. Second thing, I want to say that is really for the IMF, the reform, urgent thing is not to new proposal, new commitment, but the existing commitment, existing solution. In the past 10 years, in the each IMF communique, in the G20 communique or Joint Statement, it will say, IMF need to realignment is quota increase, quota realignment. That's the things. This year is the 16th review to be concluded. So that's provide a historical opportunity to increase its quotas and realignment its quota distribution. That's the most urgent thing. Because in the nearly 80 years of the history, each quota increase is accompanied by a quota realignment. So if in this year's Paris summit in June, the global South are very frustrated with the no progress of the IMF governance reform. So this year, if we do not achieve any progress in this area, it really affect the IMF's legitimacy and its effectiveness. So that you may notice that recent FT's article expressed this concern. So that's one thing. Another thing is that the IMF's debt framework should also be changed. As I said, Jose also mentioned, the private sector, they need to have the project selection, project management. So good project or bad project should be different when the country come into restructuring. But currently, the IMF debt restructuring framework is put the central bank swap, direct government debt, guaranteed government debt, and some of the SOE debt all together ask for possible restructuring. So that's not an incentive for the investors to invest in good projects. So as in my presentation, I say project financing is the key. So we need to encourage good project financing. That's IMF could do a good job in this aspect. I just stop here. Thank you.
So Siddharth and Axel, to wrap up here, Siddharth, I want to ask you a little bit about how the roles of the IMF and World Bank could possibly be kind of split. We've heard a few ideas here. Who should take the lead on what? What's the right balance there? And then Axel, you've alluded to this a couple of times. We've talked about quota realignment. Those of us who remember the last quota review remember how difficult and long that took to get through. So absent quota realignment, what are some of the other ideas on governance that we could consider?
Well, so yes, remembering quota discussions is very difficult. As I said before I get into the nitty-gritty of quota alignments, I'd rather sort of raise the level of money under the current quota system and deal with the quota redistribution later. There is a mismatch between voice and representation. And I think it's particularly true for climate, because for climate, we do have a double problem. The first problem is probably it's every penny spent on fighting climate needs to spend where climate vulnerability is highest. And that is in very many emerging market and frontier markets. Raising that money for them is infinitely expensive. It can be raised much cheaper in the mature financial markets. So what we need to engineer is raising money where it's least costly to fight climate where it's most effective. And that, by definition, involves the IMF and the World Bank, because it means moving money from the mature markets to the frontier markets, from countries that have climate transition issues to climate frontier markets. Very important task. The second one is we're not talking about returns. We're talking about preventing worse outcomes in the future. So there is no financial return or a risk-adjusted return for climate. What you do is you fight it now and put money on the table now, and that will be less money than you need to put on the table in the future if you don't raise that money now. And we're all doing ourselves a favor, because the one global externality we have is climate is global. It doesn't matter where you harm the climate on the planet, it infects the entire. So this is a true externality and a simple common good. And you mentioned Pigou. I mean, we know the recipes. I mean, you can ask any sort of, first-year macro 101 student, there's a problem, what do you do about it? There's not a recognition problem or a problem how to solve it, it's an action problem. Countries don't make the commitments that are necessary, and even if they make the commitments, they don't pay up as fast as is needed. And that's what we need to change. I think over time, we can always improve by not doing that well by committing more money, but at the moment, we're sort of in the grand design phase, we're not in the action phase, and Jose mentioned that as well, we need to move to action rather than need to design the systems. I'd rather redesign and adapt the system on the fly rather than sort of waiting for the plane to be perfect before we start. Because on climate, we're running out of time. The clock ticks down. It doesn't sort of run forward, it runs backward.
Siddharth?
So just to build on that and connect it with the previous panel, where it became very clear towards the end of the previous panel that a coalition of the willing will keep changing on every topic, which would mean that both in the IMF and in the World Bank, it should be possible for individual countries to be able to create a coalition of the willing according to what their needs are. And both the frameworks, the IMF framework allows for this to happen at a more higher level, a ministerial level, where these things may shift. And on a particular topic, the coalition might involve a completely different set of countries than another topic. So that's a governance reform that will make effective many of the issues that came in the previous panel. And the same thing needs to happen at the level of the World Bank, that there needs to be some level of ministerial decision-making, however it's done, whatever channel is adopted, but it needs to be done.
That'll solve the tipping point problem of the political action. I mean, these are some ideas that you all are grappling with in the report, and that's what we've heard very clearly today, throughout the day, right? I mean, the commitments have been there. We know what the problem is. We know what some of the solutions are. They've been incremental and not transformational, and there hasn't been enough political will to follow through on commitments and to really kind of steer the ship. I think we have a few minutes for questions. Want to take a few questions here if we have some mic runners. There's one here and one over here. Why don't we take a couple at a time and then we'll wrap up.
Hi, Terry Williams with Global Trust Impact Capital. So we have about $42 billion worth of deal flow right now. And we're looking at senior debt. So I took $600 million over to one of the largest banks in the country real estate portfolio. What is, this is a question for Jose, maybe blended capital from Axel. So you take $600 million, a real estate portfolio, and the new normal in the United States right now is a 60% loan to value and a 7 and 8% cost of money. So all of a sudden you had this entrepreneur who's built an enterprise value asset over 10 to 12 years of the longest elongated economic boom at 0 to 2.5%, and the new normal comes up to a 7 or 8% cost of money. So what's your strategy, or what are your thoughts, Jose, on the new normal for the cost of money? And right now I'm having to chase down things around GCC and M&E, Mezzanine, to get the cost of money down for US-based projects.
Great, and one other one over here.
I am on a spot where I get a lot of noise and I don't hear it well.
Yeah.
Thank you very much, Mahesh Kotecha. My question goes to the conduit issue and the scaling up. It seems to me that one has to challenge the notion that we, in this huge problem that we face, that we don't need new institutions. I think that's something that we should really think about in terms of something that will bring the private sector together. We need public-private partnerships on innovation. It seems to me to scale up with conduits of the kind that you just spoke about, Jose. An example in the US is the scaling up that was done in infrastructure finance with the invention in 1972 of AMBAC, and other monolines. With the advent of those monolines, $3 trillion of debt was raised to finance infrastructure in the US with no defaults, zero defaults, before the financial crisis came and the CDO squareds led to defaults by across the board for monolines, among others. But with this kind of a public-private partnership that you could have come forward, MIGA is ineffective in terms of guarantees. Its volumes are very, very low. And all guarantees at one time when I'd calculated this combined were less than all the private sector guarantors who are doing emerging market guarantees with only 1% of their capital. I think there needs to be innovation in the guarantee area with public-private partnerships. What do you think?
Okay, why don't we take these backwards? Why don't we start with the MIGA question first and the innovations and the guarantees? Maybe Jose wants to take that one, and then Axel maybe on the blended finance and the cost of capital.
I think that if you look at blended finance as a model on which to build, that blended finance is predicated on the basis of guarantees coming in order to make projects bankable. Now, you've mentioned MIGA. MIGA provides political risk guarantee. We are one of the largest users of MIGA guarantees in the world for many projects, including for Bangladesh. And I fully agree that this is something that needs to be scaled up way beyond what is needed now. I think that guarantees are extremely important. Let me give you an example. The G20 expert group on reforming the multilaterals came up with a number which is nowadays, for every dollar that the multilaterals lend, they create 60 cents of private sector capital. That's nothing. That's nothing. That's peanuts. We will not get anywhere. And they said, well, at least we should double that. Double that? That's nothing. Exactly 10 to 15. That's where you need to go. And then you need to be creative and imaginative. And I'll give you an example, talking about MIGA, because I think that's something that they did extremely well. Egypt, 6 solar photovoltaic power plants. They are financed with a loan from the EBRD, and then MIGA comes in, and MIGA provides the political guarantee for a green bond to be issued, which is then purchased by the private sector. So there was interest because it was not investing in one project, but 6 projects. There was scale. And then the private sector came in a way that they would not have done for single individual projects, and this is something that worked. So I think that in the reform of multilateral development banks, the use of guarantees is the first thing that needs to be, it needs to be scaled big time. Second, originate to distribute, critical. If you look, for example, at the African Development Bank, they have something called Room to Run, where they have very successfully used a path-breaking model for originate to distribute, originate to share from the private sector, releasing financial capacity so that they can do more. And these techniques are widely used in the private sector, and if they're used judiciously, not crazily, as it happened once upon a time, then it can be very effective. So that's the second thing which is critical. And the third thing is data. And nobody has mentioned data here. That's critical. The governance of data, but also here in the scaling up of the mobilization of the private sector, data is key. And having access to the global emerging markets risk database to the private sector would be critical. For example, the SPV I was mentioning that we are putting forward in the United Nations Alliance for the co-investment of multilaterals and institutional investors, it needs to be rated. Well, having access to that database is critical for that rating. So again, that's the other piece of the puzzle. I don't know if I've answered your question, but that's what I think about it.
Yeah, I think Mahesh
Okay,
mentioned the
thank you.
GEMS database in the last panel, so I'm sure that's music to his ears. Axel, do you want to have the final word?
Well, no, but not the final word. I think there was another question. If you want to take that, I'd rather be just two words.
Is there another question?
Infrastructure financing is something that banks used to do. I ran a Swiss bank, the two Swiss banks were founded 150 years ago to finance the Gotthard Tunnel and the Gotthard Railway. Big infrastructure projects that the public purse couldn't finance. It was private capital, private money raised for a big national project. That's what banks started off. Now, banks aren't in the infrastructure financing. We have special institutions for that. We call them infrastructure banks, the EIB. You can bring banks back into that game. You can actually put them at the core of that game, but you need to define the rules of the game. Because one of the biggest risks in infrastructure, I can tell you that, is governments changing their mind, and then investment projects that were viable when they started become non-viable when the government changes their way. On climate, we need to vow it to ourselves that we don't change our mind. This is something that is here to stay, and we're in it together. That's when you can bring banks to the climate fight, because it will not be risky, because government action, in my view, will be one-directional. There will be more climate fight in the future when we're not succeeding early. And that's where, this is all about infrastructure. This is about building energy, clean infrastructure across the world and making corporates work in a cleaner way to produce and households living in a cleaner way for the environment. This is not really a great task that is undoable. I think we just need the right infrastructure for doing it, and that means private and public money. I think everyone kind of agrees to that. It's just a question of how we do it best.
Okay, I think that was all of the questions that I saw. So I think we can wrap up today. I want to thank all of the panelists for their comments today. I want to especially thank Axel and Siddharth for the work that they're putting in to this new report on how to address the multilateral reform issues, especially with the urgent issue of climate that we've talked a lot about here today. So thank you both for all of your work. And thank you very much to all of the panelists for joining us. Thank you to the audience. I want to invite everyone. There's going to be a light reception outside in the annex area, so please join us out there for a reception afterwards. Thank you.